Bank transfers represent the next level of payment complexity. When someone initiates a bank transfer, the transaction doesn't involve physical movement of currency. Instead, accounting entries change at financial institutions. If both parties bank at the same institution, the process is relatively simple, with the bank debiting one account and crediting another. However, when parties bank at different institutions, the process requires coordination between banks. Correspondent banking networks facilitate transfers between different financial institutions. Banks maintain accounts with each other or use intermediary banks to settle transactions. This system works but involves multiple steps, fees at each stage, and settlement times that can extend from hours to days depending on the number of intermediaries involved and the currencies being exchanged. The Society for Worldwide Interbank Financial Telecommunication, commonly known as SWIFT, provides messaging infrastructure that banks use to communicate about international transfers. SWIFT doesn't actually move money, but rather sends secure messages between financial institutions detailing payment instructions. The actual settlement occurs through correspondent banking relationships. SWIFT processes millions of messages daily and has become essential infrastructure for international finance, despite not being the only such system. Card payment networks, including Visa and MasterCard, operate differently from direct bank transfers. When you use a credit or debit card, the transaction involves multiple parties, including the cardholder, the merchant, the card issuing bank, the merchant's bank, and the card network itself. The card network provides the infrastructure connecting these parties and sets rules governing how transactions are processed. Card transactions appear instant from the user perspective, but settlement actually occurs later through a process called clearing. The merchant receives funds typically within 1 to 3 business days. During this period, the card network and banks coordinate to move money from the cardholder's account to the merchant's account. Card networks charge fees for providing this service, typically as a percentage of the transaction amount plus fixed fees. These interchange fees represent a significant cost for merchants. Payment systems face multiple challenges that drive ongoing innovation efforts. Speed represents one major challenge. Traditional bank transfers, especially international ones, can take days to settle. During this settlement period, funds are essentially in transit, creating uncertainty and tying up capital. Businesses and individuals increasingly expect instant or near-instant payment confirmation and settlement. Cost represents another significant challenge. International transfers often involve multiple intermediaries, each extracting fees. These fees accumulate and can represent substantial percentages of the transferred amount, particularly for smaller transactions. Remittance payments, sent by migrant workers to family in their home countries, face especially high fee burdens, with average global costs around 6% of the transfer amount, according to World Bank data. Accessibility remains an issue globally. Billions of people lack access to formal banking services, limiting their ability to participate in digital payment systems. Even in developed economies, some individuals and businesses face barriers accessing certain payment services due to credit history, documentation requirements, or other factors. Fraud and security concerns affect all payment systems. As systems become more digital and interconnected, they face sophisticated fraud attempts, cyber attacks, and various forms of financial crime. Payment systems must balance security with user convenience, a tension that shapes system design. Regulatory compliance adds complexity and cost to payment systems. Financial institutions must comply with anti-money laundering regulations, know your customer requirements, sanction screening, and various other legal obligations. These compliance requirements serve important purposes, including preventing financial crime and protecting consumers, but they also add operational overhead. Open banking represents a significant recent innovation in payment system evolution. Open banking frameworks, implemented most extensively in Europe through the revised Payment Services Directive, allow customers to authorize third-party providers to access their bank account information and initiate payments on their behalf. This creates possibilities for new payment services that bypass traditional card networks. Under open banking, a customer can authorize a merchant to directly debit their bank account for a purchase rather than using a card. This account-to-account transfer potentially reduces costs since it avoids card network fees. Authentication typically occurs through the customer's online banking credentials rather than card details. From a merchant perspective, these transactions can cost significantly less than card payments while providing faster settlement. Open banking enables various financial technology innovations beyond payments, including account aggregation services that show customers all their accounts in one place, automated financial management tools, and alternative lending based on transaction data rather than traditional credit scores. However, open banking also raises questions about data privacy, security, and the appropriate role of technology companies in financial services. Stablecoins represent another significant development in payment technology. Stablecoins are digital assets designed to maintain stable value relative to a reference asset, most commonly a major currency like the US dollar or euro. Unlike cryptocurrencies such as Bitcoin, whose value fluctuates significantly, stablecoins aim to provide the benefits of digital assets, including fast settlement and programmability, while avoiding price volatility. Stablecoins maintain their value through various mechanisms. Fiat-backed stablecoins hold reserves of traditional currency in bank accounts or short-term securities, with each stablecoin token representing a claim on these reserves. Cryptocurrency-backed stablecoins use other digital assets as collateral, typically over-collateralized to account for the collateral's price volatility. Algorithmic stablecoins attempt to maintain value through programmatic supply adjustments, though this approach has proven challenging with several high-profile failures. Regulated stablecoins have emerged in response to regulatory concerns about consumer protection, financial stability, and compliance with existing financial laws. These stablecoins are issued by regulated entities, maintain transparent reserves, undergo regular audits, and comply with anti-money laundering and other financial regulations. Several jurisdictions, including the European Union and Singapore, have established regulatory frameworks specifically for stablecoins. The appeal of stablecoins for payments lies in their combination of stability and digital native features. Stablecoins can settle transactions quickly without depending on traditional banking hours or correspondent banking networks. They can be programmed with smart contracts to execute complex payment logic. They can potentially reduce cross-border payment costs. However, stablecoins also face challenges including regulatory uncertainty in many jurisdictions, questions about reserve management, and limited acceptance for everyday transactions. Blockchain technology underpins most stablecoins and represents a broader innovation with payment applications. Blockchains are distributed databases that maintain transaction records across multiple computers rather than a single centralized database. This distributed structure can provide certain benefits, including resilience against single points of failure, transparency since all participants can view the transaction history, and settlement finality when transactions are confirmed. Different blockchain architectures exist with varying characteristics. Public blockchains like Bitcoin and Ethereum are open networks where anyone can participate in maintaining the network and validating transactions. Private or permissioned blockchains restrict participation to authorized entities, potentially providing greater control and privacy while sacrificing some degree of decentralization. Financial institutions have explored blockchain technology for various applications beyond cryptocurrencies. Cross-border payments represent a particularly promising application since blockchain-based settlement can potentially occur faster and more cheaply than correspondent banking. Securities settlement is another area where blockchain might reduce settlement times from the current 2 days to near instantaneous settlement. Trade finance, supply chain tracking, and identity verification also receive attention as potential blockchain applications. However, blockchain technology faces significant challenges in financial applications. Scalability remains a major issue, with many blockchain networks processing far fewer transactions per second than traditional payment systems. Regulatory compliance poses challenges since blockchain's transparency can conflict with privacy requirements, while its decentralized nature raises questions about accountability and governance. Interoperability between different blockchain networks and between blockchain systems and traditional infrastructure requires technical solutions that are still developing. Central bank digital currencies represent governments' response to private digital currencies and payment innovations. CBDCs are digital forms of a country's official currency, issued and backed by the central bank. Unlike cryptocurrencies, CBDCs are not decentralized and maintain the same legal status as physical cash. Multiple countries are exploring or piloting CBDCs, including China, Sweden, and the Bahamas, which has already launched its sand dollar. CBDCs could offer various potential benefits, including providing digital payment access to unbanked populations, reducing payment costs, improving monetary policy transmission, and maintaining central bank relevance in an increasingly digital financial system. However, CBDCs also raise complex questions about privacy since central banks could potentially track all transactions, about financial stability if people shift deposits from commercial banks to CBDC accounts, and about the appropriate role of central banks in retail payments. The relationship between stablecoins and CBDCs remains uncertain. Some view them as competing approaches to digitizing money, while others see them as complementary, with stablecoins serving private sector needs and CBDCs fulfilling public policy objectives. The regulatory treatment of stablecoins may depend partly on how aggressively central banks pursue CBDC initiatives. Payment system security deserves careful examination given the high stakes involved. Payment systems face multiple security threats, including unauthorized access to accounts, fraudulent transactions, data breaches exposing personal information, and systemic attacks aimed at disrupting payment infrastructure. Security measures include encryption to protect data in transit and storage, authentication mechanisms to verify user identity, fraud detection systems using machine learning to identify suspicious patterns, and network security to protect infrastructure from cyber attacks. Biometric authentication, including fingerprints and facial recognition, has become increasingly common in payment systems, offering stronger security than traditional passwords while providing user convenience. However, biometric systems raise privacy concerns and are not immune to sophisticated attacks. Multi-factor authentication, requiring multiple forms of verification, provides stronger security than any single authentication method. The balance between security and user experience shapes payment system design. Stronger security often requires more steps or information from users, potentially reducing convenience. Payment providers must calibrate security measures to the risk level of different transactions, applying stronger authentication for higher risk scenarios while keeping routine transactions frictionless. Cross-border payment challenges deserve specific attention given their economic importance and current inefficiencies. Individuals and businesses send trillions of dollars across borders annually for purposes including remittances, trade payments, investments, and travel. Yet cross-border payments often cost more, take longer, and involve more complexity than domestic payments. Multiple factors contribute to cross-border payment challenges. Different countries have different payment systems that may not connect directly, requiring correspondent banking intermediaries. Currency exchange adds costs and introduces foreign exchange risk. Regulatory requirements vary across jurisdictions, creating compliance complexity. Time zone differences can delay processing when parties are in different regions. Lack of standardization in payment messaging formats creates inefficiencies. Various initiatives aim to improve cross-border payments. The Financial Stability Board, an international body coordinating financial regulation, has established a roadmap for enhancing cross-border payments with goals including reducing costs, increasing speed, improving access, and enhancing transparency. Different approaches include linking national payment systems directly rather than using correspondent banking, harmonizing regulatory requirements across jurisdictions, extending payment system operating hours, and adopting common standards for payment messages. Payment system regulation reflects the critical importance of payments to economic functioning and consumer welfare. Regulators pursue multiple objectives, including protecting consumers from fraud and unfair practices, ensuring payment system safety and soundness to prevent failures that could disrupt the economy, promoting competition to prevent monopolistic pricing, preventing financial crime, including money laundering and terrorism financing, and protecting privacy and data security. Different countries take varying regulatory approaches. Some maintain strict separation between banking and other financial services, while others allow more integration. Some adopt technology-neutral regulation, applying the same rules regardless of the underlying technology, while others create specific frameworks for new payment methods. Some emphasize innovation and competition, while others prioritize stability and consumer protection. The appropriate regulatory framework for payment systems involves balancing competing considerations. Excessive regulation can stifle innovation and increase costs, while insufficient regulation can expose consumers to fraud and enable financial crime. Regulations designed for traditional banking may not fit new payment technologies well, yet creating entirely separate regulatory frameworks can create complexity and regulatory arbitrage opportunities. Financial inclusion represents both a challenge and an opportunity in payment system evolution. Approximately 1.4 billion adults globally lack access to formal financial services, according to World Bank data, concentrated in developing economies. Lack of financial access limits economic participation, makes saving difficult, and forces reliance on expensive informal financial services. Digital payment systems could potentially expand financial inclusion by reducing the cost of providing financial services, reaching remote areas through mobile technology, and enabling people without extensive documentation to access basic services. Mobile money services in Kenya and other African countries demonstrate how digital payments can serve previously unbanked populations. However, digital payment systems also require digital literacy, device access, and connectivity that may be barriers for some populations. The future of payment systems likely involves coexistence of multiple approaches rather than a single dominant technology. Cash will remain important for many transactions despite growing digital payment adoption. Traditional banking and card networks will continue serving hundreds of millions of customers while adapting to competitive pressure. Open banking and account to account transfers will grow where regulatory frameworks support them. Stablecoins may find niches in specific use cases while facing ongoing regulatory scrutiny. CBDCs may launch in various countries with uncertain adoption trajectories. Innovation in payment systems continues across multiple dimensions, including speed of settlement, cost reduction, user experience improvement, security enhancement, and expanded access. Technologies including blockchain, artificial intelligence, biometric authentication, and mobile platforms all play roles in payment system evolution. However, technology alone doesn't determine payment system success. Regulatory frameworks, user adoption, network effects, and institutional trust all matter enormously. For individuals evaluating claims about payment innovations, several principles provide useful guidance. First, understand that genuine innovation takes time to achieve widespread adoption. Payment systems exhibit strong network effects where value increases as more participants use the system, making it difficult for new systems to displace established ones quickly. Second, distinguish between technological capability and actual market adoption. Many technologies work in laboratory or pilot settings but face challenges achieving scale. Third, recognize that cost savings claimed for new payment technologies may not account for all costs, including regulatory compliance, fraud prevention, and customer support. Fourth, remain skeptical of claims that any single technology will completely replace existing payment infrastructure. Evolution typically involves gradual change and coexistence rather than sudden replacement. In conclusion, payment systems are experiencing significant innovation driven by technological advances, changing consumer expectations, and competitive dynamics. Understanding the fundamentals of how payment systems work, what challenges they face, and what innovations are emerging provides essential context for evaluating claims about the future of payments. While predicting exactly which technologies and approaches will prevail is difficult, the direction toward faster, cheaper, and more accessible payments appears clear across multiple initiatives and technologies. Payment system infrastructure involves complex technical and operational components that most users never see. Understanding this infrastructure helps evaluate claims about payment innovations and their potential impact. At the core of any payment system lies the ledger or database recording who owns what. Traditional banking uses centralized ledgers where the bank maintains authoritative records of account balances. When a payment occurs, the bank updates its ledger to reflect the new balances. This centralized approach provides clear accountability and enables the bank to reverse transactions if necessary, but it also creates a single point of failure and requires trust in the central authority. Distributed ledger technology represents an alternative approach where multiple parties maintain synchronized copies of the transaction record. No single entity has exclusive control over the ledger. Changes require consensus among participants according to predetermined rules. This distribution can provide resilience and transparency, but it also introduces challenges around coordination, efficiency, and governance. The appropriate ledger architecture depends on specific use cases and priorities. Settlement represents another critical component of payment systems. Settlement is the actual transfer of funds that completes a payment transaction. Different payment systems use different settlement mechanisms with varying characteristics. Real-time gross settlement systems process and settle each transaction individually as it occurs. This provides immediate finality but requires participants to maintain sufficient liquidity since each transaction settles individually. Many central banks operate RTGS systems for high-value transactions between financial institutions. Net settlement systems accumulate transactions over a period, then settle the net position at predetermined times. If Bank A owes Bank B money from multiple transactions, while Bank B simultaneously owes Bank A from other transactions, net settlement calculates the difference and transfers only the net amount. This reduces liquidity requirements since many obligations offset each other, but it also introduces settlement risk during the accumulation period before final settlement occurs. Payment system interoperability deserves careful consideration. Interoperability refers to the ability of different payment systems to work together, allowing participants in one system to transact with participants in another. High interoperability increases payment system utility by expanding the network of potential transaction partners. However, achieving interoperability requires technical standards compatibility, shared operational procedures, and often business agreements between system operators. International payment interoperability faces particular challenges. Different countries develop payment systems independently with different technical standards, operating rules, and regulatory frameworks. Connecting these systems requires bridging technical differences, aligning operational procedures, and navigating regulatory variations. Some regions have made substantial progress on interoperability, such as the single euro payments area in Europe, enabling seamless euro payments across countries. Other regions have more fragmented payment landscapes with limited cross-system connectivity. The economics of payment systems involve multiple considerations beyond simple transaction fees. Payment systems exhibit strong network effects where the value to each participant increases as more participants join. This creates natural tendencies toward concentration with a few large networks dominating. However, it also means that new payment systems face significant barriers to achieving critical mass, since initial participants find limited value in a small network.